Good afternoon, everybody. Welcome to the second session today. I'm James Forder. I'm economics tutor at Balliol College, and I'm academic and research director of the Institute of Economic Affairs. That's nothing to do with it, however, because my role is to introduce two very distinguished speakers. First of all, we have Michael's a senior research advisor at the Bank of England, where he's leading research. He's formulating and leading research. He developed a IFM DSG model, is interested in monetary reform, including central bank digital currencies and full reserve banking, which is, I suspect, what he's going to talk about. He's published in a whole string of leading journals, including American Economic Review, Journal of Monetary Economics, Journal of Money, Credit and Banking, etc. And taught at Stanford University. My little note here says he's a citizen of that hotbed of inflationary outbreak in Germany. So, full reserve banking. Michael, over to you.
Thank you very much. Is my screen clearly visible to everybody?
Yes, it is.
So thank you for the opportunity to present in this venue. This is a paper that was originally published as an IMF working paper back in 2012, together with Jaromir Benes. Both of us are no longer at the IMF. You will notice that my name here I have without my current affiliation, which is on the program, but I'm not listing it. This is because, to make it quite clear that this work is in no way associated with my current employer, and it's basically work that I did at the IMF, and it's research work, and it does not reflect the opinions of any of the institutions with which I am or have been associated. So to introduce the topic, the Chicago Plan was formulated in the 1930s and was a result of a profound debate about how to make the financial system safer in the wake of the Great Depression, which is pretty much why I wrote it in the wake of the 2008-2009 crisis. And I think some of the problems in the financial system that were being addressed by that are in different forms still with us today, and who knows what the aftermath of COVID-19 holds. In the 1930s, it was supported by Irving Fisher, Henry Simons, Frank Knight, basically most or all of the leading macroeconomists of that time, after World War II by Milton Friedman, basically the founders of the Chicago School of Economics, who saw control of finance and absence of laissez-faire in finance as a precondition for laissez-faire in industry. They also had an excellent understanding of the nature of banking, on which I will about which I will talk next, because this is essential to understand what the Chicago Plan at the time was trying to reform. What the Chicago Plan proposed was the separation of the monetary and credit functions of banking, whereby deposits would have to be backed, or would actually have to be 100% reserves of public money. And credit could not be financed by the creation ex nihilo of bank deposits by banks, as it is happening today. And before I launch into this, and before any of you thinks this is an outlandish proposal, just remember that virtually all central banks in the world are nowadays discussing CBDC. And as I will mention right at the end, that's like a small cousin of the Chicago Plan. It's very significant differences, but also similarities. So understanding banks, the key function of banking is money creation, not intermediation. Banks do not intermediate pre-existing loanable funds, as you will often see in macroeconomics nowadays, because there are no pre-existing loanable funds, because banks create the funds that they need to lend at the moment they make the loan. Banks also do not accept or collect deposits from non-banks. They only collect deposits from each other, because when somebody deposits a check in a bank, that check only has value because it was drawn on an account that already has funds in it. At another bank, when you consolidate the banks, this does nothing but move funds around. It doesn't create new funds. Instead, the way deposits are created is through lending, also through securities purchases, but in the numbers that is significantly less significant. This is a fact, not a theory. We don't need to validate this theory. It's simply a fact of life, as I have said in many papers, starting with Jakob and Kumhof paper in 2015, whose title started, "Banks are not intermediaries." Banks, they are of course intermediaries, but not in the sense of intermediating loanable funds. Banks can therefore quickly start a lending boom. They can simply grow both sides of the balance sheet by creating money. They do not first have to attract deposits of existing money. And of course, that lending boom may well be justified, but it may also not be. And that's part of the point here. Reserves or cash balances impose no constraints on this process. I will discuss that. The main constraints are banks' expected solvency and profitability, and that's very much in the eye of the beholder, being the bank, being the bank itself. This is a schematic representation of the loanable funds model at the top, where there's a saver depositing something and then the bank lending it out to somebody else. This cannot be a check deposit, as I just explained to you. So what these models essentially are about deposits of real resources in a warehouse type institution. That's not our banks. At the bottom, I have the financing through money creation model, which will also be in the model of the Chicago Plan and will be what is reformed through the Chicago Plan, where a loan of money creates a deposit of money. That deposit of money will then, of course, circulate away from the borrower, but other deposits will circulate back to the borrower. This circulation doesn't really matter in the aggregate because the aggregate quantity of deposits will be unchanged as long as the quantity of loans is unchanged. Again, exempting securities purchases and sales from this picture. Second, the deposit multiplier is a myth. The deposit multiplier, as you all know, is that the idea that the central bank fixes narrow money aggregates first, and then they are lent and relent, so that broad monetary aggregates are a multiple thereof. Kydland and Prescott have shown that in the monetarist era even, the actual transmission worked in the opposite direction, whereby it is broad money aggregates that lead the cycle and narrow lag the cycle. Lending and credit creation comes first, and the reserves come later. Inflation targeting era, it's of course pretty obvious, because if you control the interest rate, you have to let the quantity of reserves adjust, otherwise you lose control of the interest rate. So the conclusion is that the transmission starts with loan creation that equals deposit creation, ends with reserve creation. I have a statement here from a very senior Fed official around the time where monetarism began to be debated very hotly. And banks therefore have significant control over the money creation process, and the Chicago Plan would remove this control over the money creation process, but not over the money allocation process, as I will explain. Banks would intermediate government-supplied money. Money creation would no longer be based on private debt creation. Banks no longer control the quantity of money, but they do control its velocity, which is very important to remember. So now let's turn to the advantages of the Chicago Plan that are pointed out in that paper back in 2012. I still stand by that, although I am working on an update with an updated calibration, an updated model, and the benefits. Some of the benefits are significantly larger, but that's still going to be a few months before that. Before I try to publish that. So dramatic reduction of private and public debts are the first two advantages. And the way I explain that is usually by way of a sequence of balance sheets that represent the aggregate financial system in the US, where the numbers here represent percentages of GDP. And this is not just commercial banks, but it also includes some of the shadow banking sector, etc. And I have there on the asset side various types of loans plus holdings of government securities, which are not very large because the majority are not held by the banking system. Although 20% at that time, the calibration is based on around about 2006, 20% of GDP worth were held by the banking system. And then on the liability side, I have mostly deposits. I lump everything into one, call it deposits and equity. Deposits could be split further, but for the purpose of this, it's not that important. Models have to be as simple as they can be in order to make the point. So Chicago plan says to the banks, if it were implemented, all your deposits need to be backed by reserves. Because these reserves do not exist, the Treasury stroke central bank, leave that open, the government, the public sector can create these reserves by lending them to the bank. So the bank now also has a new liability, which I call Treasury credit. This is 184% of GDP, and then it has acquired the reserves. That's the 100% reserve cover. Now, in the next slide, we're just going to rearrange this so that we have money banks at the bottom, where each deposit basically is reserves. It's like having an account at the central bank, or it is having an account at the central bank. That depends on the technical implementation. And at the top, you have what you call the credit investment, what I call the credit investment trust, which still have all these various forms of credit on the asset side, but now a huge deposit basically by the Treasury. However, that's not the end of the story. The next step would be for the Treasury to repay the government bonds either as they fall due or to repay them early, depends on the individual terms on the bonds. Credit investment trust balance sheet shrinks. The next step, and these steps are all optional, right? I outline an optional sequence of events of how this could be done. So the next step could be that part of the Treasury credit is converted into citizens' accounts. So the government's accounts becomes a citizens' accounts, and that these citizens' accounts are then used to repay short-term and mortgage loans. Again, they don't need to be repaid, but the net effect is the same, right? Because it's your net liabilities that matter. And in the model, we assume that they're repaid. Credit investment trusts shrink even more. Now, the only loans remaining are what I call investment loans. These are loans for physical investment to firms. What could or should be the core business of banks that support a productive economy. Now the equity can shrink a little bit because there's fewer assets to support on the asset side. And then the next step is to say, even this could be further reduced. The Treasury credit could be used to pay the holders, the remaining holders of government debt at market clearing prices, so that instead of holders of government debt, they would now be holders of liabilities of credit investment trust. Treasury credit could shrink to close to zero. This is to illustrate that all of this could leave behind a banking system that is very substantially private in its allocation of credit and its involvement even on the balance sheet of the government. However, the money that people use would now be basically national money reserves in the central bank. The flip side of this is the government's balance sheet. On the left side, you have the original balance sheet with bonds on the liability side. Then we issue Treasury credit and reserves. Of course, they are on the respective other side of the balance sheet. When you look from the point of view of the government, Treasury credit is an asset. Reserves is on the liability side. But as I've shown in a recent paper with a bunch of legal co-authors, including the recent nominee for controller of the currency, Saule Omarova, and also Rosa Lastra here in London, this is not properly a debt of the consolidated government, but rather a hybrid that has more in common with equity than with debt, but it's also not equity. So basically what you have therefore done by doing this conversion is to get rid of a lot of debts in the economy and instead replace them with money on people's balance sheet. And this money is not something that can ever expected to be repaid. This is not defaultable, and there are no repayment terms on money. I can't summarize the entire legal paper here, but it's there for all of you to download. Okay, so the next advantage that we point out in the paper is large output gains due to low real interest rates, due to lower debt levels, both public and private. Means lower leverage, public and private, means lower interest rates due to risk, etc., etc. Lower real interest rate for the government budget means the savings can be deployed somewhere. We assume that they're deployed by reducing taxes on saving, capital accumulation, and on working. And that removes distortion and stimulates the economy. And third, more abundant liquidity due to getting closer to the Friedman rule when you issue money publicly rather than relying entirely on the banking system with its various regulations, market power, etc., etc. So here are the simulations for the transition in real terms. These are quarters on the horizontal axis, 15 years. It takes a while because this is actually a structural change that permanently changes the level of taxes and real interest rates and liquidity as well, which is not shown here. GDP rises by 10% in the very, very long run. Real interest rate drops substantially. The labor and also capital income tax rate, which is not shown, drops substantially. Inflation can be reduced. The inflation rate can be reduced without a problem because this is not an inflationary policy, as I will explain. Fourth advantage, complete elimination of bank runs. Money is completely safe because its value no longer depends on either the quantity or the performance of private debts, because what sits on the other side of the balance sheet of the money issuer is not private debts. A run on the credit system could still happen, but the payment system would remain 100% safe, and credit problems could be dealt with separately. The payments rail could continue unaffected. Fifth, much better control of credit cycles. The money creation privilege of banks can be a major source of credit cycles, which can be good, but can also be bad. And I don't think anybody would argue that all credit cycles have been good. The credit decision can be funded 100% in-house in the bank through money creation. And if banks do this in lockstep, it doesn't mean that the bank that does it will lose a particularly large quantity of deposits or any. Furthermore, government guarantees on the liabilities of banks, which are explicit or implicit, and they are required because this guarantees the viability of the payment system. The payment system is the lifeblood of the economy, but it also means that banks and depositors pay less attention than they otherwise would to risk. Under the Chicago plan, the money creation privilege is removed. Intermediary banks must first persuade investors to make a cash deposit. This deposit needs no government guarantee of any kind because it's an investment, it is not money. And investors will therefore be more cautious and impose discipline on the banks more than they need to prior to a Chicago plan world. Both of this makes credit-driven business cycles less likely, but of course it doesn't rule them out completely, because things can go wrong. Institutions can lend too much, but they can also lend too little. Okay, now there are problems with the Chicago plan, and the one that we point out in the paper is basically getting the transition right, which is very much also something that central banks are now talking about in the context of CBDC, but there are many problems that I would call non-problems. And the first two is, and sometimes the critics point them out in the same breath, is too much money or too little money. I'll start with too much money and then go to too little money. The idea behind too much money is that public money creation becomes excessive and leads to inflation. There is no reason to expect that for three reasons. One is monetary theory, two is institutional arrangements, and third is history. There's a lot in the paper about that. I really only have time here to talk about monetary theory, and that's the first one up here. Inflation is determined by the relative quantities of goods and money in private hands, the standard quantity theory, right? And under the Chicago plan, the quantity of money in private hands remains completely unchanged. What changes is the nature of money. And so there's no reason to expect inflation from that point of view. Here is a little illustration again showing the balance sheet on the left is the initial balance sheet of the banking sector. The one on the right is the eventual balance sheet, and in the middle, what happens when you first issue the reserves and the treasury credit. What is red shaded there is deposits. They are, it's a bit of rounding going on, but in the model simulations, it's essentially the same. But when you look at what deposits represent on the top left, it's various types of private credit. When you look at what they represent on the top right, it is reserves in the central bank. So basically, what we call indestructible public money replaces destructible private money, destructible either through lending contractions or defaults or what have you. Okay, so no reason from this point of view to expect inflation. Now, too little money. The idea here is small businesses will be starved of credit and money under this system. Counter argument is that this is a question of price. What does the model say? And the model is sort of trying to weigh up a lot of real world arguments and trying to quantify them. So there are implications of much lower debt levels. What are they? First, public debt goes down, public leverage goes down, risk-free rate goes down. That means cheaper borrowing. Second, private debt goes down, leverage goes down, spreads go down. That means cheaper borrowing. Third, private cheap deposits also go down because there will be a reallocation whereby banks will be funded differently, and not the credit investment trust will not be funded by cheap retail money anymore, but rather by risky investor money, risky investor deposits, or even equity. That means that lending rates will go up to the extent that investment trusts price their loans off their deposits rather than off the policy rate, which is it's an open question, and there's in the academic community, there's debate about pricing, and most people come out somewhere in the middle. But that would indicate more expensive borrowing. Our paper says that the net effect is substantially cheaper borrowing. So at least in terms of price, the average firm is less likely to have to be in debt to obtain cash. And this is very important to remember. There are two reasons for that. One reason is that some people are different. There's heterogeneity. Some need cash, some have cash. The banking system channels or intermediates between the two, and in that sense, it does intermediate. But there's another reason for that, which is that's the way we create our money, and that reason would fall away under the Chicago Plan. So that means the banking system would only exist because of this heterogeneity, and not because of the need to create the money supply. That would mean that the debt-based money supply could be the debt-based credit system could be substantially smaller, and the average person would just be in less debt. Many would not even have to be in debt. Let me skip over the last point because time is running out. Maturity transformation is another criticism, and the system may be unable to offer desired maturity profiles. The counter argument is that the point is maturity, not transformation. Maturity transformation is all very well, but what we really want is maturity. If it doesn't require transformation, that's no big deal. So maturity transformation accomplishes two objectives: the desired maturity profile, short-term liquid assets for savers, long-term illiquid liabilities for borrowers, and may reduce borrowing costs. And the Chicago Plan accomplishes both of those objectives, and we argue it does better because the desired maturity profiles are available separately from credit investment trusts and money banks without any maturity transformation, and borrowing costs are lower due to the large, what we call debt to equity swap. Finally, money substitute. Can you actually control the quantity of money if money substitutes can arise in the private sector? That is something to be vigilant about. Nobody would argue with it. The economists of the 1930s didn't think that that was a problem that was impossible to overcome. I don't think so either. There are many reasonable countermeasures. One is the government only accepts public money in payment in the bond market, primary bond market, and for taxes. That makes private money less viable. Deposit insurance for private liabilities is withdrawn because they are now investment liabilities, and money per se doesn't need deposit insurance. That would make private liabilities much less suitable as money. removing tax advantages for borrowing, introducing tax advantages for equity financing, again, shifts the playing field towards equity financing, maturity mismatch regulations, and legal incentives to pay in public money. The last one is legal prohibition on paying in private money, but I don't think you need that. But, you know, this is sort of the whole spectrum of things that you could do. So central bank digital currencies is an idea whereby sovereign money exists alongside commercial bank money, and distributed ledger technology was the key innovation that brought that up, where you could basically make access to the central bank balance sheet by a very large number of people technically feasible. In the Chicago plan model, the central bank money is the only money, and under CBDC, central bank money and private bank money coexist, which means even under CBDC, you get similar benefits, but they're significantly smaller. It's much less radical departure from current banking practices. But as you can clearly see from this outline, it's a close cousin of the Chicago plan. So conclusions. What can we learn from the 1930s debate? About the nature of the financial system, what we can learn from those leading economists is that banks do have the privilege of being able to create money to fund loans. This implies that bank balance sheet can grow and shrink very rapidly in a manner that has nothing to do with saving, national account saving. It also imparts a debt bias to the entire financial system. And this makes discontinuing that privilege at least a legitimate part of the debate. It's not clear that, you know, that we want that, but it makes it a legitimate part of the debate. And that's all I'm saying. About monetary and financial reform, the Chicago plan calls for the end of the money creation privilege, has maximal benefits, but also requires the most radical transition. Do we have new reform options today that didn't exist in the 30s? Yes, because of new technologies which make sovereign money more practically feasible in the eyes of many. I'm just repeating what other people have said. As I said, CBDC is actually on the agenda of many central banks around the world right now. So it's fascinating to see how much this debate has moved since I first issued this paper in 2012. Thank you very much.